Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned in to On Trend, the show designed to keep you on the right side of the trend. So the S&P 500 is flirting with its 200-day moving average, and this is a great time to review the 200-day moving average. I'm going to show you how it's worked in the past, show you how to reduce whipsaws, look at SMA signals versus exponential moving average signals. Then we'll see how these signals work with other indexes and what would happen if we used signals from the S&P 500 with other indexes. And finally, why do we want to use market timing at all? So here we've got the S&P 500. That is the gray line there. And the red line is the 200-day moving average. And you can see there have been quite a few crosses of the moving average over the last 25 years. Some periods we get whipsaws with several crosses. If you look here in 2015, you look here in 2010-11, also in 2012 there. And even in this period here over the last few months, we've had several crosses of the 200-day. All told, there have been 90 bullish crosses, which implies there have been 90 bearish crosses because you move up and above and below. So if you've moved above it, that implies you moved below it before that. So there have been like 180 crosses of the 200-day moving average, and I count 90 bullish crosses. And if you bought when there was a bullish cross and sold when there was a bearish cross, you would have had 20 winners, and your average gain would have been 13.7%. Of course, with moving average crossovers, there are lots of whipsaws. And moving average systems are by definition trend following systems. So they tend to have bigger winners than losers, but they also have lots of small losers. And here we can see just using the 200-day cross, you would have had 70 losing trades, but the average loss would have been just 1.32%. So clearly, when you look at this system overall, there is a bullish bias to the cross above the 200-day moving average. But what we need to do, though, is we need to reduce the whipsaws and keep the gains. And how can we do that? Well, the first step would be to smooth out the price there with another moving average. Before showing you that step, if we just look at the S&P 500 over the last 3 years, look at those whipsaws we had in 2015. We had one there in the summer of 2016. That was the Brexit vote, by the way. We had another whipsaw in the spring of 2018. And then we had a number of crosses there in October, November 2018. Now, we're never going to eliminate whipsaws. They are going to be with us for the rest of our trading and investing life. It is just part of the process, part of the game. All right. Here I've applied a 5-period moving average, and we have the 200-day still in red. And I put the S&P 500 just below that plot. And the S&P 500 is, of course, invisible on this top chart here. So you can just focus on the crosses. But you can see here we went from 90 bullish signals to 34. We seriously cut down on the whipsaws just by adding a 5-day moving average. And you can see we had 15 winners and 19 losers, but the average gain was 15.8%, which is definitely respectable. And the average loss was 2.769%. So again, you're getting much bigger gains than you are with losses. And I'm only looking at bullish signals. The market has a long-term upward bullish bias. You just look at any 5-year chart, you're probably going to see it moving from the lower left to the upper right. And therefore, 70% of the time, it pays to be bullish. Sure, 30% of the time, you can make money maybe being bearish. But if you saw with this counter trend rally that we just had, it's tough to make money on the downside. All right, so we're going to take this one step further. And at the end of this, I'm going to show you a table that's going to sum up all of the signals here. But now what we've got is a 20-period moving average with the 200-period moving average. And you can see we've gone down to 16 signals. since 1994. It's like a 25-year period. We had 11 winners and 5 losers. And look at the average gain. It jumped up above 20%, and the average loss was around 2.5%. It stayed about the same. Just by smoothing out that moving average, you have less signals, all right? And fewer signals means less anxiety, I would think, because the more signals you're looking at, the more decisions you got to make, and that creates more stress. So by stretching this out a little bit, we can still get good returns, and we can have fewer signals, which means less stress. Now, if you look here, you can see that we got a bearish signal there at the beginning of November. That was like November 1st or 2nd, and we have yet to cross above the 200-day moving average as I speak. And what about the granddaddy of them all? The golden cross, the 50-day and the 200-day moving average. So here we got the 50-day in green, the 200-day in red, and you can see we're down to 11 bullish signals over this period. 9 were winners, the average gain almost 30%, and 2 were losers, and the average loss is still hovering around 2.6, 2.5%. So you're going to get whipsaws, as I said. There's nothing you can do about it. Here we got one in 1998. You can see a couple more during this bull run here in 2004-05. Another one in 2010, 2011. We got some whipsaws in 2015. And currently the 50-day is below the 200-day right now. So just to add some granularity on the 2 losing trades, they were in 2011 here. You can see we had the cross above the 50-day crossing above the 200-day, and then the 50-day crossing below the 200-day. And meanwhile, the S&P 500 was lower when the 50-day crossed below. And then, of course, we had the cross at the end of 2015, and then in January we crossed below, so that was a losing trade as well. But you can see these moving average systems are designed to catch the bull runs, and there will be whipsaws. The key is sticking with the system, which is easier said than done. So the numbers I'm about to show you were generated using Amy Broker software. You can see up in the upper left, and it is software designed to backtest your trading strategies. There is a pretty steep learning curve in doing it, and their charts are definitely not as nice as ours. So you do need both. I think you need the stock charts workbench, and I kind of complement the stock charts workbench with some backtesting in Amy Broker. All right, so here's a table detailing the results. We've got buy and hold first, and buy and hold for the S&P 500 over this period from 1994 to 2019 would have had a 7.26% annual return. But you can see buy and hold comes at that drawdown of 56.77%. In fact, you had 2 50% drawdowns along the way. Then if we look at the moving average crossing above and below the 200-day, your compound annual return was 6%. And you can see as the moving average, as we go from 5-day to 20-day to 50-day, you can see the compound annual return increases. Exposure remains the same. Your risk-adjusted return increases. And your drawdown, it goes to 20% when you use the 5-day, and it hovers around 20% for the other 2 moving averages, the 20-day and the 50-day. And then to the right are the numbers that I showed you on the chart, the average gain, the average loss. And look at the winning percentage. You can see the winning percentage increases as we added a moving average. So this is the close. This is the 5-day moving average. This is the 20-day moving average, and this is the 50-day moving average. So there's a sweet spot there at the 20-day. You have roughly a 69% winning percentage, and your average gain is 24%, and your average loss is 2.5%. All right, so this is something we want to keep in mind when we're looking at the S&P 500. So what about using an exponential moving average instead of a simple moving average? Well, I'm going to do that next. We'll look at those test results. But first, let's look at the difference between an EMA and an SMA. On this chart here for the S&P 500, I've got the SMA, 20-day SMA in red, and the 20-day EMA in green. And you can see that the 20-day EMA will turn up usually before the SMA. There it turned up, and then the SMA turned up. And if we look here, we can see that the 20-day EMA turned down just before the SMA did. And then we look here in January, the 20-day EMA turned up a couple weeks before the 20-day SMA. So the exponential moving average is weighting recent price action heavier than past price action. So the last 5 days of the moving average, the most recent 5 days, are going to weigh a lot more than the first 5 days of the moving average. And if we look at the 200-day moving average, the EMA is green, the SMA is red. And you can see that the EMA started turning down in October, November, and then the SMA started in October. And look how the EMA was already moving lower at a pretty good clip, and then the SMA started. And the SMA, keep in mind, is taking all 200 days and averaging them, and that EMA is putting more weight towards the most recent price action. Now, which one is better? Well, that's kind of like asking, is log scale better than arithmetic scale? It's just one of these questions that really doesn't have a straightforward answer, because sometimes one works better than the other. Sometimes the other works better. You just never know. And they're both trend following indicators, and usually you get similar results over the long term. So I've added a table here for the exponential moving average just below that table, testing the simple moving average for the S&P 500. And first of all, let's look at the average gain. You can see that the average gain at the longer end is bigger for the exponential moving average than the simple moving average. So you get +1 there. But then you look at the winning percentage at the longer end. The winning percentage is high for the simple moving average, but it kind of drops for the exponential moving average. So those kind of cancel out each other. And then when we look at, just raw returns, you can see it goes from 6% to 8.43% for the simple moving averages, and then from 6.42% to 8% for the exponential moving averages. So, one is not necessarily better than the other here. I would probably, out of all these moving average pairs here, I think the one that I would pick would be this 20-day, 200-day crossover. It seems to be the golden middle. All right, the 50-day, you're going to get more lag. All right, it's going to take more time for your signals to materialize, and you're going to get fewer signals. You can see you had 11 signals with the 50-day crossing above the 200-day, and you had 16 with the 20-day crossing above the 200-day. You're still getting similar returns, 8% versus 8.43%. But when you look at the risk-adjusted returns, it's a little bit less for the 20-day. But I think I would rather, give that up and get some earlier signals using the 20-day. So what about moving averages and the other major indexes, such as the Dow Jones Industrial Average or the S&P Mid-Cap 400? Well, to tell you the truth, they all pretty much test worse than the S&P 500, some much worse. And the only one that tests better is the NASDAQ 100, but the drawdown is pretty high. And if you look at this chart for the Dow Jones Industrial Average, I think it is one of the worst indexes or averages to use when it comes to moving averages, because you get more whipsaws and bad signals in this one. You can see a lot of crosses there in 2004, 2005, a dip here in 2013. Look at the decline in 2001, 2000. So there were a lot of whipsaws there. It's 30 stocks. It's price weighted. It's not my favorite, but you can't tell that much. You can get an idea, but you really need to crunch the numbers to see what the actual results say. And we're going to do that for these indexes coming up. Here's the S&P Midcap 400, 20-day moving average in green again, 200-day moving average in red. I'm just going to stick to that pair. I don't think there's any sense in trying to find the best pair for each index, because once you find a moving average that fits, that fit stops working usually. You can see the NASDAQ 100, it's a volatile one, and so it's going to have more crosses because it's going to have deeper dips and higher highs, usually on the rises because of the volatility. So it's prone to whipsaws as well. Russell 2000, it's a more volatile index as well. You know, look at all these crosses during the bear market of 2000, 2001. And you can see some crosses there in 2014. So it's a tricky one. The S&P Small Cap 600 as well. So let's look at how these look when we crunch the numbers. All right, so here's a table going from 1994 to February 2019, crosses when the 20-day moving average crosses above the 200-day moving average. That generates the bullish signal or buy signal, and you sell when it closes below. The signals are generated on the close, entry, exit on the next open, no commissions, slippage, or dividends. So when we look at that, we kind of have the S&P 500 as our benchmark, and you can see the compound annual return was 8%. The only one to beat the S&P 500 was the NASDAQ 100, but you can see the drawdown was quite high at 35%. So that means that anytime you're holding a portfolio and you had the NASDAQ 100 long, your drawdown, you would have been down 35% at one point during that portfolio. And you look at the winning percentage. I mean, this is pretty amazing. 69% for the S&P 500, but very much weaker for the other indexes except for the S&P 500 equal weight. So, you know, these indexes aren't performing that well. The average gain, man, NASDAQ 100, 53%. Average loss, 5.76%. But keep in mind you have big drawdowns along the way. And you can see the winning percentages are slightly in favor of the bulls with a few. You can see the Dow Jones Industrial Average, more losses than winners on this trading strategy, whereas the S&P 500 have 11 winners and 5 losses. So clearly the Dow is the worst as far as the moving average system is concerned. And the Russell 2000 would be the second worst because it is tied with winners and losers. So the S&P 500 clearly generates the best signals when it comes to this 20-day moving average crossing above the 200-day moving average. And you know, personally, I don't think there's anything special about the 200-day moving average as far as marking support or resistance. It's not a magical line that says we're bullish when we go above it and we're bearish when we go below it. But it's just in general, you know, the market, the cup is half full when you're above the 200-day, and the cup is half empty when you're below the 200-day. Now, when it comes to the S&P 500, it is the most widely followed benchmark for stocks in the U.S., and the 50-day and the 200-day moving averages are probably the most widely followed moving averages, and I would guess that the 200-day is the most widely followed moving average. So you put those two together, you have the S&P 500 and the 200-day, and so many people are watching it that it kind of becomes a self-fulfilling prophecy. And so I smooth it out a little bit by adding that 20-day moving average to, you know, reduce the whipsaws, but still catch the trends should they take hold. No trend, no profit. That's what all trend following systems need to be profitable, is a trend. Now, what if you took these signals from the S&P 500 and applied them to, say, the NASDAQ 100 or the Russell 2000 or even the Dow? All right, so here we got the S&P 500 above and we got the NASDAQ 100 below. And we know the NASDAQ 100, you know, it's the high beta, large cap, tech, growth, biotech. You know, that's where the big moves are going to come from. And so we can get the stability from the S&P 500, the stableness of the signals, but we can get the beta, the outperformance, by using something like the NASDAQ 100. So let's look at that. All right, so don't glaze over just yet. Bear with me on this table. I'm going to break it down for you and just show you the highlights on it. But basically what we're showing is they're the signals based on the actual index. So the Dow Jones Industrial Average with its signal, that's the white line there. And then the green line shows the performance for the Dow Jones Industrial Average using signals from the S&P 500. When the 20-day moving average crosses above the 20-day moving average for the S&P 500, you buy the Dow, and then you sell when it crosses below, you sell the Dow. And then we did it for the NASDAQ with the S&P 500 signals and with the NASDAQ 100 signals, the S&P Mid-Cap 400, the Russell 2000, and the S&P 500 equal weight. And for reference, there is the S&P 500. Compound annual return of 8%. So when we look at the signals here, we can see that we can improve by taking signals from the S&P 500 and applying them to that other index. So if you look at the compound annual return for the NASDAQ 100 with S&P signals, it was higher than the return for the NASDAQ 100 with its own signals. Look at small caps. All right, you only got a 4.2% compound annual return when taking signals from the Russell 2000, but if you base your signals on the S&P 500, you got a 7.5% annual return. And then we look at the wins and the losses. All right, if you took NASDAQ 100 signals, you had 11 winners and 10 losses, 50%. But if you use the S&P 500 signals, you had 13 winners and just 3 losses. That improved greatly. And you look at mid caps, all right? You had 12 winners and 10 losses if you use the S&P mid cap signals, but if you use the S&P 500, you had 12 winners and 4 losses. A big improvement. Same for the Russell 2000. 16 winners and 16 losses using the Russell 2000 signals, 12 winners and 4 losses using the S&P 500 signals. So I think the lesson learned here is the S&P 500 is the king. And those are the signals we want to watch for. And you can apply those signals to other indexes much easier or much more profitably than you can using the index's own signals. In other words, forget the signals in the Russell or the Dow or the NASDAQ. Use the signals in the S&P 500. So what's missing in these tests that I'm doing? Well, some people might say commissions, but commissions, they're small these days, and the effect of commissions depends on the size of your trade. So that's why I'm not including them. And I'm looking at the major indexes. So what is missing, I think, is dividends. All right, here is a chart with SPY and dividends in green. It's a performance chart going back to 1994. And then we just have the S&P 500 index, which of course does not include dividends. And if you look at the performance differential, you can see at the 2007 high, we're up like 300+%, and then the index was up like 270%. But look at that from 2009, that outperformance. So the S&P 500 with dividends is up like 820%, SPY, since 1994. Whereas the S&P 500 without is only up 480%. So if you're trading the S&P 500 using one of these systems, you're going to be collecting dividends if you're using SPY or one of the other ETFs. Now, as much as I like dividends, and I think they do need to be incorporated into your testing results because they are part of the return, so you need to look at the total return. You got to keep in mind over the long term, you're going to get something called dividend drift. And what is that? Well, I've got a chart here, and we've got the S&P 500 in the top window, and we've got SPY with dividends in the lower window. S&P 500, no dividends. SPY with dividends, total return. And I've got some highs and lows marked here for reference. So first of all, you can see the S&P 500 broke below these lows here, but SPY did not. That's because the dividends are giving it an upward drift. Similarly, the S&P 500 didn't break above this high, whereas SPY did. All right, the S&P 500 eventually did, but the dividend drift is giving an upward bias. And then if we look forward here to August, we can see we cleared that high just barely, or we didn't for S&P 500, and we did just barely for SPY. And then if we look at the 200-day moving average here, it held in June, July there of 2016, but it was broken for the S&P 500. And you can see that we broke it briefly for the S&P 500, but held it for SPY. So that is what dividend drift is, and it does have a long-term influence on the charts. So I wouldn't worry too much about dividend drift short term. It really shows up in the longer term charts, especially when you look at things that have big dividends like XLU utilities or XLRE REITs. This is a chart showing the S&P 500 and the S&P 500 total return index, $SPX TR, and we've got the 20-day and 50-day moving averages for reference here. But you can see this low here. We touched that October low with that close, but we held just a hair above it. So not a big difference there. And you can see we're currently just below that December high in the S&P 500, whereas the total return with dividends is closer to that high. So that's what dividends do when you add them back in. They show the real return, which is your total return. All right, but sometimes if you're looking for a new high, a higher high, a breakout, you probably need to use the index. And this is also the reason I like to use the index for my moving average analysis using the 50-day and the 200-day or the 20-day and the 200-day. So that's why when I look at the broader market, I'm looking at the S&P 500, all right, because it is the index to analyze, and I think it's the best one. So why would we want to use market timing at all? Well, there are two reasons. The first is to preserve capital. All right, bear markets don't come along very often, but you can see that we had two bear markets, 2000, 2001, 2002, and of course 2007, 2008. And if you had used a simple timing technique, you would have been out of those bear markets and preserved some capital. Now, the cost of doing that, of course, is you're going to get whipsaws on deep pullbacks, but you are going to catch some pretty darn good uptrends along the way. A few whipsaws there as well. The second reason is it tells you when you want to take on risk, all right? When do you want to look for riskier stocks, stocks with higher betas, stocks with higher growth rates? When do you want to try and outperform? You want to do that when the S&P 500 is in a broad uptrend, and that's how you can use market timing to tell that when to take risk. And the last chart I'm going to show you here is the S&P 500 with SPY. So we have S&P 500 buy and hold 7.26% per year, with dividends using SPY 9.27%. If we trade just using the 200-day and 20-day moving average, with the S&P 500, you would have had a compound annual return of 8%. But if you added in dividends using SPY, you would have bumped that up to 9.5%. That's a pretty good return. And you would have been in the market only 72% of the time. All right, the other 28%, you would have been out. You could have been in cash. You could have been in bonds, money markets, whatever. All right, and there you can see the drawdowns. All right, the drawdown is the main reason. Without market timing, you have 50% drawdowns. With market timing, you get that drawdown down to the 19-20% area, and that makes it a lot more tolerable. And then you can see the winning percentage is around 70%. All right, and that concludes this edition on the 200-day moving average. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.